So as you can see, the earlier example in which we saw that return on equity is net income by equity, right? That is further divided into three parts: net profit margin, total asset turnover, financial leverage. And we have given the formula of that. Net profit margin, we all know, is net income by sales. Asset turnover would be sales by total asset, and financial leverage would be total asset by equity, right? Now, what is net profit margin? So net profit margin in any business basically tells how much of the business, basically it talks about the pricing power and the advantage the business has over its consumer. So only when a business like an FMCG business, where consumers look at the brand and don't look at the price, those companies generally have a higher margin. When you compare that with a commodity business, it would be difficult for a commodity business to have a higher profit margin, because their products are not based on brands, but based on the demand supply mechanics. So when it is demand supply based, if the supply overrules the demand, you will be having a tough time. So you are not a price giver, price setter, but you are a price taker. So the market determines price for you. But when you are a company with a brand or a pricing power, you set the price, and that shows up in your net profit margin. The second is asset turnover. So asset turnover is net sales by total asset. So what does it mean? As the mathematical formula says, the more sales you can generate from the least amount of total asset, the better it is for your company. So as we got to know that in case of net profit margin, it is more from the pricing power or consumer advantage. Asset turnover ratio is indicative of production advantage. When you have been able to efficiently manage the whole production cycle, your asset turnover would be on a higher side. Asset turnover basically is indicative of production advantage, right? So what happens in case of production advantage? There is something you are doing efficiently in your business that helps you in generating more sales given the total asset you have compared to your any competitor. That is where you will have a higher asset turnover ratio, right? So as net profit margin was a indicator of production and consumer advantage, asset turnover ratio is an indication of production advantage, right? Now, what is financial leverage? Financial leverage is probably one of the trickiest lever to understand. Most businessmen by default understand the other two levers, but this is something which both investors and business owners fail to understand generally, and we'll cover examples in the subsequent slide which will make it more clear to you. But just to give you a context, the best businesses are those which manage to do their work to expand without using the owner's capital, right? So what do I mean by saying that without using the owner's capital? That means they get possession of other people's money. So we have written here OPM, you can see in the slide, right? That OPM means other people's money. And how do other people's money come to a good business? That comes in the form of trade credits, deposit from distributors, advance from customers, deferred tax liability. So only when a business is having some sort of a competitive advantage, they would get trade credits or deposit from distributors. If I start a business today and I do not have any kind of pricing power or brand or any sort of competitive advantage, who will give me trade credits? Which distributor is going to give me deposit, right? And why will customer give me advance, right? So those things happen only when there is some sustainable advantage or competitive advantage in a business. So this is again one of the levers which helps the business